Good morning, good morning, good morning. Can everybody hear me?
Good morning, yes.
Good morning. I hope everybody is fine today. All things considered. Let's give the others a few more minutes before we begin, and then we begin. Okay, let's begin by hook or by crook today. Natasha, are you still there?
Good morning, I'm here.
Wonderful, wonderful. Welcome aboard again. Andrika. Andrika is somewhere trying to get in. Edrika. Andrika's are somewhere. Cheryl.
Right here.
Hey, good morning.
Morning, all.
Good morning, good morning. And Jerry. Jerry's still on honeymoon. Okay. My. All right, so we're going to begin. I guess the others will join us along the way, but the ship has to keep moving. Before we get started, Natasha, Cheryl, any questions about the last homework you want to raise before we move on? Or if you think of anything, we can, always raise it later this morning.
No, I just raised my questions on Thursday. I submitted the homework yesterday. You
Yeah.
just need to confirm whether or not everything was right.
Yeah, I saw it come in, so look at it. But you didn't have any issues that just kept nagging you in the back of your mind.
No, I was good. Once
Yeah.
we knew how to deal with the deficit, capital deficit.
Absolutely. As a matter of fact, that's usually the one area where the students get a little stuck because most of the time they're not aware that the deficit is actually cleared by personal funds, which means it has no impact on the liquidation or the partnership directly at all. Right?
Right.
So once you understand that concept, then the rest of it is pretty manageable. All right. So I think the last time we were talking about the journal entries for salaries, we looked at the wages expense for a particular organization, the total wages expense, which is debited to wages expense account because it is an expense of doing business, and then all of the amounts that had to be paid to the federal government and the pension fund, etc., all credited to the respective general ledger accounts. It's an interesting thing about accounting, which I hope you've gathered by now. Even though you may not be accountants by profession, even though you may never go on to be what we call a professional or lifetime accountant, just an understanding of how transactions are created, journalized, and posted can really, really give you a lot of insight on what goes on in business organizations. Okay, very important issue. The other thing is, if you don't remember anything else, God forbid, just know that if you journalize a transaction incorrectly, whether it's $10 or $10 billion, the financial statements will be incorrect. If you post anything incorrectly, the financial statements will be incorrect. So this stuff that we did in accounting 1, and we're visiting a little bit for journal entries and transactions, they never go away because they are the ABCs of the profession. Right? It's like a nurse being able to give a needle. I mean, how can you call yourself a nurse if you cannot give a needle properly? Which is interesting because there are many doctors who are terrible at giving needles. If you go to the hospital and the doctor says, I'll give you a needle, maybe you should run. Because a lot of them, even though they're doctors in their specific fields, they are horrible because they never really got to learn how to do that at all or well. Okay? So these are the building blocks. And a lot of organizations don't seem to still be aware that getting it right at the transaction, journal, and posting level is fundamental to getting everything right at the end of the day. Okay? And then again, some people know it too well. Because they know it so well, they even manipulate transactions in order to steal, embezzle, and misappropriate transactions within a particular company. So we have the good side of it, and we have the evil side as usual. All right. Andrika, I see you just joined us.
Yes, I'm here. I'm having technical difficulties, so I'm on data instead of Wi-Fi. I hope it lasts.
My. Well, we can hear you. We can hear you. So hang in there and tell Data don't play. He could go out at 11:30.
11:30. Okay.
Or thereabouts. Okay. So let's go back then to where we were. See if we can get through the rest of this today. Even if we don't, for some reason, I don't see why we shouldn't. We still have Thursday, which is going to be partly a review class. I will start a little discussion on the next chapter, which I believe is has to do with corporations on Thursday, but it'll only be a little itsy bitsy discussion because I don't want to get too much of that tied up as you get ready for your midterm exam on Saturday. Okay. And besides, you might have some questions from chapter 11's homework, which I'll assign today anyway. So Thursday is probably going to be mostly a discussion review session. And depending on how that goes, I may not introduce anything new to the equation to mix things up mentally. I might just say, okay, if you have a little bit of time left, you are to go and get ready for your final exam and nothing else. Okay, so we'll see how this whole thing goes. All right, so the wages are debited to wages expense, all the other payments to the government and to the pension fund are credited to a payable account. Once the payment is made, then the transaction would be complete. Let me ask you something. That journal entry that we made for $65,000 to wages expense, when we pay those payables, okay, the federal income, state security, and all that stuff, when we actually make the payment, what journal entry do you think we'll make? No dollar amounts, just give me the journal entry upon payment of the liabilities. What journal entry do you think we should make once the payment is made? Well, remember, we debit salaries, wages, expense, and we credit all those payables. So when you pay the payables, what journal entry do you make?
Would you would debit the wage payable, and credit cash, the cash account?
Okay.
Would you?
Yes. That is correct. You debit the payable accounts. If it's only wages payable, then you debit wages payable. But if you have all those other payables, then you have to debit all the payables. You follow?
Yes, because in some cases, some company put all the payables to one payable account.
Yeah. And I hope that's not too often. Because that too will distort the information. And sometimes companies do that in order to hide certain things, which is why the accounting profession will tell you at this stage of the game, when you are creating accounts, there should be a separate account for every single transaction, all the way down to miscellaneous. Don't get too caught up in putting too many things in one account that should be broken out so we could see what really happened.
They'll call it miscellaneous payables, actually.
Yes. I'll tell you a little secret, Cheryl, who's in the real world of book accounting. If you see a miscellaneous account anywhere, your curiosity should be piqued.
Check the details.
Oh, you know that already. Yes. Nobody's saying that you cannot have a miscellaneous account. But if you've been around accounting for any period of time, you should know. And if you don't know yet, you must know now that miscellaneous is an account for small transactions that don't really fit anywhere else appropriately because of the amounts involved. Okay? So miscellaneous accounts, period, should be very small balances compared to the rest of the general ledger accounts. If you see a miscellaneous account with $50,000 in it, that better
Oh,
be a
no.
multi-billion-dollar company.
No, that's a red flag.
Oh yeah. And even if it's a multi-billion-dollar company, you still have to check it, like, what the hell is in there? Okay, because companies often hide certain transactions in miscellaneous. That's their favorite account for hiding stuff. And even if you're the internal auditor or you're responsible in the accounts department for those kinds of things, and folks are trying to hide stuff, and you go to senior management and says, what are these things? Depending on what they're up to, they'll give you funny looks. They'll tell you, I've spoken with the financial controller already. That means you shut up, or whatever the case might be. The point is, it's an account to check if the balance in that account is too high. Okay? We put it simply for the moment. Okay, way to go, Cheryl. I know you've been around this craft a little while, seeing some interesting things. So yes, and nothing has changed. Companies still try to get away with stuff all the time. And they try to get people involved in getting away with it too. That's another issue, but that's an ethical class. That's not an accounting class, even though the accounting class will tell you you are required to be ethical if you expect to be a professional or good bookkeeper accountant. Like any other profession, stay away from hanky pankying. But that doesn't stop people from staying away from hanky pankying. We tell people stay away from each other for a while, don't go to groups, don't have any parties, don't sneak around with anyone, because COVID is still out there and people are still doing it.
Hmm.
The hospitals are full, we don't have any treatment, the vaccines are coming in late than we thought, but we're still doing it. The numbers are still going up. That means people are not listening to the rules. Same thing happens in any other area, interestingly enough. And then when the thing starts to get worse again, who do we blame? The doctor from over the hill, as if he has anything to do with where people go. How could he stop them from going around, sneaking around, hanging around, and partying in groups? He cannot. Or anybody else for that matter. So even if you bring in another prime minister and people are still sneaking around, running around, doing whatever they want, nothing will change. But again, we all know that. And the same thing happens with accounting. If you don't follow the rules, certain things are going to happen. And even though there are penalties and other issues attached to it, people still try to get away with stuff every single day, interestingly enough. All right. But that's the ethical side of things. And again, that's a whole other class, maybe. All right. And then we looked at the employer's payroll. Remember, we have two, the employer has to do two payrolls, one for the employee and then one for the employer. So together, every time payroll is done, we have the employee's side and the employer's side. So if you look into your notes in our discussion, you'll see that they'll tell you that the payroll taxes and benefits expense for the total consists of pay employee plus employer together. And typically, in most organizations, the employer side of the payroll expense is about 1/3 of the cost as well, as is the employee side, which is about 1/3 to 40% overall in most organizations. All right. So, any questions on the payroll side of it? Probably should be pretty straightforward once you understand those two different categories. Remember, the payable is established only until it's time to pay. Until you pay the bill, it's a liability, it's an accrual of some kind, and then when you pay the bill, you debit the payable account and you credit cash. Okay? That's why it's important also to be able to get these things right, preferably the first time, because usually once you get the initial transaction right for payroll, it doesn't change unless somebody new comes into the company, add them to everything, somebody leaves, you take them out. But once you get the initial payroll structure as with any other structure correct, it doesn't change. debit expenses, credit liabilities. When you pay the bill, you debit the liability, credit cash. Every week, every month, every year. That's the other beautiful thing about accounting. It's very consistent. Once you get it set in place, the rules do not change very much. Okay? Unlike lawyers and accountants and others, sorry, lawyers and economists and others, they get up one day and say one thing, and political scientists, then they go to sleep and they get up in a bad mood the next day, so they say something else. Or somebody gives them some money and they say something else. Accounting is not like that. Okay? A debit is a credit no matter what mood you're in or no matter how much you get paid. Now you can manipulate it, but the rules do not change. Okay? All right. So now we're on to this very unusual account, this liability account called unearned revenues. Does everybody see that? Unearned revenues.
Yes.
Yes. A lot of students get stuck on unearned revenues because they say, well, it's revenues, how come it's a liability? That's the first question often. Well, it's a liability that just happens to be called unearned revenues. Okay. And the reason we call it unearned revenues because unearned revenues are usually what we call advanced payments. Anybody know what an advance payment is? Advance payments. Ever heard that?
Funds paid before it's due, like vacation, I think.
Yeah, it could be vacation or anything that's paid before it's due. For example, if somebody comes to clean your yard or paint your house or do some maintenance work, like contractors and other people come to do some work around your house, what do they tell you? I need a payment what? Upfront? You guys don't do any stuff like that?
Yep.
Or they will probably ask for a deposit.
Yeah, same thing. Miss,
Okay.
I need a deposit. That's the same thing. It's an advance payment. And this, again, this is what kind of throws people off because we recognize what a deposit means, but we don't always recognize that the deposit is the same as an advance payment because advance payment sounds so sophisticated. And we're so used to say, we don't, when people come and say, excuse me, do you require an advance payment? We don't talk like that. But that's what it means. And then, of course, you give the deposit and they say they'll be back tomorrow at 3. And then what happens? Cheryl, they say they'll be back tomorrow at 3. And what happens?
They don't show up.
But they still have your, but they still have your money though.
Right, they committed to the service, put on their schedule.
On their schedule. Then you call them and say you were supposed to come at 3. What do they tell you? Something came up. If they answer the phone in the first place. Am I the only one on this planet or am I the only one that's run into such people? Well, I hope not. And if you haven't run into them, you will. If you're too young yet, like Natasha and company, I promise you, you will when the time comes. Be careful how you make advance payments. Because sometimes people take your advance payment and they don't show up on schedule. And some of them never show up again. And you cannot find them. So make sure you're careful who you give an advance payment to. Because that means that they have created a liability in their books because whatever you gave them the advance payment for, they're supposed to provide you with that service. So until they provide that service in their records, they have a liability that they owe you that service. All right, that's how advance payments work. The reason why we call them unearned revenues because the revenues are not earned until you do what? Anyone? If you get money to do the work and you haven't done the work, have you earned the revenue?
No,
No. Yeah, you have not earned it until you provide the service. Simple as that. It's really not complicated at all. Even though you got the money. Okay? And a lot of people who provide services and who don't have proper accounting systems and stuff like this, they don't even understand this. And some of them, they just like take the money and they do the work and they don't even have any accounting records to begin with. And they don't want to pay any accountant to create any, because they don't want to be bothered with that at all. Just give me my money, let me do it or not do it. Give me my money, and that's it. All right. So that's why we say that unearned revenues are liabilities, because until the person, entity, company, whatever provides the service to that company, the revenue is not earned yet. And it will not be earned, even though they already have the money, until they provided the service. Once they provided the service to you, then they can transfer from unearned to earned. Okay? All right. So if you look in our transactions, there's a little journal entry right under that note. Do you guys see that journal entry of an example of unearned revenue?
Yes.
Is that the $360 example, or your number is different?
Yeah, 360.
Yeah. Okay, so you have this entity, company, that offers a subscription or membership, and so they're collecting the money up front, because when papers or magazines or gyms or whatever offer subscriptions or memberships, they usually require you to pay upfront, correct? And that's what we call the advance payment. In this case, the advance payment for membership is $360. Notice what the owner of the company does right away, the fitness center. They debit cash because they receive money, and they credit what account?
Unearned
Unearned.
revenue.
Yeah, unearned revenue. Why are they crediting unearned revenue and not revenue?
Because it's not revenue yet, because they collected the cash upfront. It's unearned because
Yeah,
they for a membership.
absolutely. They haven't earned any of yet because you haven't put in your 1 month of work yet. They haven't provided you with your 1 month of service yet. And remember, their promise is that that 360 covers 12 months. And so they're not going to recognize revenue until the end of each month. That's how it works. So when they get the money up front, they cannot record a revenue because none has been earned yet. Okay. All right. And so that's the initial journal entry for the advance payment. And as you can see, like every transaction in accounting, it must be posted. I'll tell you a secret that you should know already. If you journalize a transaction and don't post it, it'll be like it never happened. Because the posting is the record of the transaction being recorded in the ledger. And for the most part, if a transaction doesn't hit the ledger, it will not hit the financial statements. Not for the most part, never. If the transaction doesn't hit the general ledger accounts, they will not get to the financial statements. And so persons who are up to no good or who are untrained or who are a little lapsed in the way they do their work, they could easily record a journal entry. And if you don't have, for example, a computerized system where it's automatically posted, they may not remember to post it, or they may not post it on purpose. Leave it unposted so it never shows up in the financial statements. Like I said, there are all kinds of ways to get around everything if you think hard enough, and people are always thinking hard. That's why we have auditors, internal and external, to come in and check things out, because folks are always trying to either deliberately or by accident or because of poor training create all kinds of problems within the organization. Remember, auditors are not only coming in to look for thiefers, quote unquote, that's Bahamianese for persons who steal, but they're also looking for errors that are legitimately made, maybe by persons who are new, not properly trained, and so they're making a lot of mistakes, or they're not taking their work very seriously, and so they're making a lot of mistakes, things like that. And so they're looking for legitimate and illegitimate activity in the organization. Okay? When your auditors come in, they're not just looking for people who are doing stuff out of the way. They're looking for what we call errors that could occur naturally by anyone. Anybody can make a mistake or two or 10, depending on their situation. All right. So the 360 is earned and is collected It's unearned revenue until it's earned. When does the company earn its first revenue? When does the company earn its first revenue from this transaction?
June 30th.
Yeah, how many days later is that since they got the money? When did they get the money?
They got the money on the 1st.
Yes. So at the end of the first month, they have now provided 1 month of service to the clients, and therefore they can now record that earned revenue appropriately. And notice the journal entry for recording revenue once it's earned. Right? You debit the unearned revenue account and of course credit the revenue account. And notice, do not ignore the narratives, please. When you are reading and studying, read the narrative. A lot of students don't like to read the narrative for some reason. And then worse, they don't like to write them because they just think it's a bloody pain in the butt. But narratives are very important in accounting. It provides an audit trail. It tells anybody who comes after you, even if you're dead, what happened at a glance, and it makes everybody's life easier. Okay. So please don't be shy when the time comes to reading and writing narratives. All right. Why is it $30, anyone? Why is the revenue only $30? Where did that come from?
That's 1 month's payment.
Yeah, that's 1 month's payment. How do we know? How do we know it's 1 month? Where did you get that 1 month from? Did you like guess it?
It's paid on June 30th, and then it says at the end of the first month.
Okay. Okay, way to go, Natasha. She read the narrative and she said, that's exactly my point. Because that narrative is there, Natasha didn't even have to think about what happened. Now watch this. If the narrative was not there, what would you have done, Natasha? Like no narrative.
I guess go by the date.
Go by the,
By the date. How was the end of June,
okay.
and then you probably pay for the month because
Do we just guess it or something tells us there's something somewhere in there that says it represents 1 month, other than the narrative? Well, when we're reading the transaction, what does the transaction tell us?
it is paid in advance for 1 year.
Aha, there we go. It's paid in advance for 1 year. So if 1 month has passed, even without the narrative, how do we know it's $30?
You just divide the 1 year subscription by 12.
Exactly. Okay. I just wanted somebody to get down to that part of it. You just divide it by 12, 360 by 12, and you get your monthly subscription. Now, in today's modern world, there's some software out there where you could put this in the system and it does it automatically each month. But not everybody still has software yet. And so a lot of stuff is still being done manually, especially for small businesses who can't afford or want to be bothered with all that techno babbled mumbo jumbo. And so whether it's done electronically or manually, that's the process. And some people might say, well, why do we need to be bothered? And we have the computer. Well, the computer is as dumb as a bat. Did you know that? Did you guys know that the computer is completely stupid? What makes the computer work?
The computer's as smart as you are.
No, they're as dumb as a bat. What makes a computer work?
Information,
Who puts it there?
people.
If we put in the wrong information, does the computer correct it?
No, that's why I said as smart as you are. If you
Oh,
put in the
yeah.
wrong thing, the
Thank you,
wrong thing.
Carol. I appreciate, yeah. Thank you very much. Thank you very much. Now I get your point. It's as only as smart as we are. So if we're not so smart, the computer's gonna do some funny stuff too. We can't expect like why this stupid computer is not getting the right thing. Well, probably because we're not putting something in correctly. Okay, so she's exactly right. It's only as smart as we are. It works faster. It doesn't get bored. It's more consistent than we are and all that stuff. But when it comes down to information, it can only do what we tell it to do. So doesn't matter how many computers we have, we still have to learn the rules. We still have to learn it correctly so that we could put it into the computer correctly. Otherwise, it'll be calculating fast and furiously, except it'll be calculating the wrong thing, which happens all the time, by the way. Sometimes people put a lot of wrong information in the computer, either deliberately or not, interestingly enough. All right. Any questions so far? So now there's no further confusion, I hope, about the expression unearned revenues. A lot of students get caught on that one. Okay. Now we come to an interesting part called estimated liabilities. And this is the part of accounting where the numbers are not always definite. We have to estimate. Notice we don't use the word guesstimate in accounting. And there's a reason why. Because for accountants, guesstimate is on the lower end of the scale that doesn't have any basis for what you are estimating. You just wing it. And you wing it with no basis for your estimate. So we don't get into the word guesstimate. If we say in accounting that some accountant has guesstimated, that means that they have no idea on how accountants estimate. That's the point. So we're going to see a little bit about how accountants estimate in this particular section. All right. Do you guys have the focus on business practice in your text? The one that says little coupons add up and frequent flyer amounts? Do you have those? No? Yes?
Yes, business perspective, what is the cost of frequent flyer miles?
Yes. What about the one before that? Little coupons add up.
Okay, it comes after that. Those little coupons can add up business perspective as well.
Okay. But you do have your heading estimated liabilities.
Yes, sir.
Okay, great. So I guess Natasha will get you out of the way first so you can think a little bit, and then we'll bring on the others. All right, so let's pick up at estimated liabilities. Now, when you're reading that, what I'd like you to do is when you get to those two business practice issues, I'd like you to read those two because they are very good examples of estimating liabilities, and will give you some insight on that this very important part of accounting that does not relate to hard and fast numbers. Okay. And also
Okay.
give you some idea as business students in general. See, you're not just studying debits and credits, general ledger transactions. That's those are the fundamentals of accounting. But there are a lot of little other practical things. That's why they put them here so that you can understand them even as a non-accountant. And that's kind of the beauty of this thing. And the reason why I'm asking you to read is because sometimes when you're in semester time and you have all kinds of pressures and homework and reading, chapter reading, also, man, I'm not reading that because when in fact it sometimes has some very important stuff in it. All right, so let's begin. Estimated liabilities.
Estimated liabilities are definite debts or obligations whose exact dollar amount cannot be known until a later date. The primary accounting problem is to estimate and record the amount of the liability. The following are examples of estimated liabilities. Income taxes payable. The federal government, most state governments, and some cities and towns levy a tax on a corporation's income. The amount of the liability depends on the results of a corporation's operations, which are often not known until after the end of the corporation's fiscal year. However, because income taxes are an expense in the year in which income is earned, an adjusting entry is necessary to record the estimated tax liability. Sole proprietorships and partnerships do not pay income taxes. However, their owners must report their share of the firm's income on their individual tax returns.
Now, let me say this. These refer to the United States and Canada and UK and other countries like that. We don't have income tax yet, but we will one of these days. I just hope it's after my death or retirement, whichever comes first. Uh, but sooner or later, the Bahamas will be forced to introduce income taxes because the government is going to need more and more money to do what governments do, waste money. But that's just the nature of things. So this whole thing about income tax in these countries, in the United States in particular, sole proprietorships and partnerships do not pay income taxes. So if I ask you that in a true false question, do not get stuck on that and say, yes, they do. All right, they don't. What happens is whatever money is made from the sole proprietorship, profits or partnership, they go into the personal income declaration of those partners and persons, and they pay taxes on a personal level. Corporations, on the other hand, they pay income tax on their net profits or net income. The other thing about income taxes, as she read, notice there's a timing difference between when the government taxes are due to be paid and when the financial year of the company comes to an end. If, for example, the government taxes are to be paid next year, you won't know what that amount is until the government sends you a bill next year. But your company records have to be closed this year because your financial year ends December 31st or September 30th or whatever the month is. And so you have to estimate, you being the company, has to estimate what your tax bill is up to the closing date for that financial year. It's an estimate because you won't know the exact figure until the government sends it to you next year. And so what are these estimates based on? Previous years. We look at what we did in previous years, what the government's bill is usually, and we come up with an estimate. And that is the estimate that we put into our financial records. So if we estimate the tax bill to be $30 million this overall, that's not the exact bill. That's only our estimate based on experience. Then we will use the $30 million by debiting income tax expense at the end of the financial year this year and crediting income tax payable next, that will be paid next year. Of course, next year, when the bill comes and you know the exact figure, what you will do is you pay the exact figure. If it's more than your estimate, then you have to pay more. If it's less than your estimate, then you adjust your $30 million estimate down to what the exact tax bill is. Okay? But for now, the important thing for you to remember is that income tax payable is an estimate. It's an estimate only because we don't know what the government's bill is going to really be until next year. But even though we don't know what it is this year, at the end of our financial year, we must come up with an estimate for our records. Otherwise, our records will be grossly under or overstated. Okay? All right, keep going.
Property taxes payable. Property taxes are a main source of revenue for local governments. They are levied annually on real property, such as land and buildings, and on personal property, such as inventory and equipment. Because the fiscal years of local governments rarely correspond to a company's fiscal year, it is necessary to estimate the amount of property taxes that applies to each month of the year.
Same principle. Next year is going to be different. We have to estimate it this year. If we're applying it on a monthly basis or annual basis, we have to estimate it until we get the property tax bill next year. Anybody in this class has a mortgage yet?
Yes.
Okay, so if you have a mortgage, every year you will get a tax bill as at December 31st of that year. You won't get it within that year. You'll get it early in the new year, telling you what your tax bill is at real property tax. It's the same principle. Companies will get a tax bill as well. Now, the problem is they won't get it until the next year either. But for this year, they have to estimate what that's going to be and put an estimate in the records. We as individuals, we don't estimate anything. We just hope that they forget to send us one. But in business, we have to estimate it and put it into our accounting records. And then when we get the correct amount, then we fix the numbers. That's how it works. Okay. So the point here is just to show you the different examples where estimating becomes necessary in accounting for reporting purposes in the fiscal current year until we find out the correct figure the following year, and then we correct it.
Mr. Wilkinson, excuse
Yes.
me. So why won't the property tax be a fixed amount
In the Bahamas or in general?
in general?
It should be a fixed amount. For
That's-
example,
Because
typically,
they have it for estimate as estimated liabilities.
who has it that way?
That's what the book is talking about, right?
Oh, the book. Okay, the book. Well, that's a good question. That's a very good question because it's very relevant to this discussion. In practice, the tax rate is fixed by the government, property or income. Okay? The reason why companies have to estimate, let's say the tax bill is coming next year for the company, correct? The company will not know the exact tax bill amount until next year, even though the rate is fixed, because of the nature of the government. Sometimes they change the amount that they charge the rate on. In other words, let's say they're charging the rate on the current market value. The current market value next year might be different from the current market value in their estimate this year. So it means that they cannot say that your bill will be the same next year as it was this year. And so because the government cannot say that and will not say that, we can only estimate based on our last tax bill, for example. We'll say, okay, last year our tax bill from the government was $20,000. So we're gonna say, estimate that it's 20,000 this year. Okay, and that is what we will put in our records. However, when you get your tax bill next year, it may not be 20,000. You follow?
Yes.
It might very well be something else. And once, if it's not the 20,000 that you estimated based on last year, and it's something else, higher or lower, you will then have to make the adjustment next year in your records. You
Okay,
follow?
so in that case, it varies depending on the rate. Okay.
Yeah, or yeah, the rate or the principal balance that the government uses to calculate tax.
Okay.
And that will vary from country to country. In the Bahamas, for example, real property tax is usually fixed, and the principal amount of the value of the property is usually fixed at the moment. Until recently, it never changed. But now the government of the Bahamas is looking at changing the format from charging the rate on the fixed value to the market value. So many people in the future, and in the very near future, will find themselves paying more in real property taxes now because market value does what? Change ever so often. So if you pay taxes on a market value 2 years ago, let's say your market value is 250,000 on your home, in 2 or 3 years, if they can start to use market value, your market value in your home may go up to 350,000. And then what's going to happen to your tax bill? What's going to happen to your tax bill? It's going to go up. Okay? And the same thing happens with companies. But that is based on government decisions. Technically, the tax rate bill is fixed in some jurisdictions, so you pay, you have a known amount, you don't have to estimate, you know it's going to be. In many other jurisdictions and parts of the world, though, the liabilities change in terms of income tax and property taxes, and so therefore what you put in your records may not necessarily be equal to what the government sends you a bill for. And whatever the differences are, accounting has the ability to make the adjustment. The key is, even though you may not know the exact bill, you still have to record an estimate in your books. That's really the key. Okay? All right, keep going.
Promotional costs. Coupons and rebates are part of many companies' marketing programs. Because of frequent flyer programs, for example, US airline companies today have more than 10 trillion free miles outstanding. What are the accounting implications of these promotional programs? Companies usually record the cost at a reduction in sales, a contra sales account, rather than as an expense with a corresponding current liability. Hershey Foods Corporation accrues almost $1 billion in promotional costs each year. In its annual report, Hershey acknowledged the difficulty of estimating the accrued liability for promotional programs. Accrued liabilities requiring the most difficult or subjective judgments include liabilities associated with marketing promotion programs. We determine the amount of the accrued liability by analysis of programs offered, historical trends, expectations regarding customer and consumer participation, sales and payment trends, and experience with payment partners associated with similar previously offered programs.
So you
The
can see, sorry, Natasha. So you can see that they use all kinds of mechanisms to help them estimate what their promotion cost will be. But the truth is, you cannot really come up with an exact figure. It's almost impossible. Just like when you sell gift certificates, some people will come in to redeem them, some will not. But you cannot tell who and how many people will come in. So it's all an estimate. And that part of accounting cannot ever be a science because we cannot predict what people will or will not do. And wherever accountants cannot predict what people will or will not do, as in the pandemic, we don't know what people will or will not do. We're doing all kinds of egg. It's the same. What accountants have to do then is come up with our very best estimate. And notice all the different variables that we consider to come up with these estimates to give us a number that makes sense rather than just an old stinky, what we call guesstimate, which is based on nothing. All right, keep going.
The estimated costs of these programs are reasonably likely to change in the future due to changes in trends with regard to customer and consumer participation, particularly for new programs and for programs related to the introduction of new products. Product warranty liability. When a firm sells a product or service with a warranty, it has a liability for the length of the warranty. The warranty is a feature of the product and is included in the selling price. Its cost should therefore be debited to an expense account in the period of the sale. Based on past experience, it should be possible to estimate the amount the warranty will cost the company in the future. Warranties on some products will cost the company very little, others may cost a lot. Business perspective. What is the cost of frequent flyer miles? In the early 1980s, American Airlines developed a frequent flyer program that awards free trips and other bonuses to customers based on the number of miles they fly on the airline. It is estimated that 180 million people now participate in similar programs. Estimated liabilities for these tickets have become an important consideration in evaluating an airline's financial position. Complicating the estimate is that almost half the miles have been earned through purchases from hotels, car rental, and telephone companies, internet services providers like AOL, and buying credit cards. Recording product liability transaction. A muffler company like Midas guarantees that it will replace free of charge any muffler it sells that fails during the time the buyer owns the car. The company charges a small service fee for replacing the muffler. In the past, 6% of the mufflers sold have been returned for replacement under the warranty. The average cost of a muffler is $50. On July 31st, Midas must record the accrued liability and related expense. The
Okay.
company sold 700 mufflers during the month.
All right. Thank you, Natasha, for that great job, all that stuff already. So let's back up before we look at the accrual and the liability connected to it for this particular warranty situation. Let's go back to the frequent flyer miles for a moment. 180 million people back then. It's much, much more now. Um, no doubt who've taken advantage of this. And of course, frequent flyer miles are like gift certificates. You don't know when people are going to use them. You don't know how many people are going to use them in any particular year. And some people may never use them ever, or they may roll up like 10 years later trying to use it, which is why sometimes frequent flyer miles have a what? Expiration date. Anybody in this class has frequent flyer miles anywhere?
No.
I guess like me, have to fly frequently first. We fly, but not that frequently. But many Bahamians do have frequent flyer miles because many Bahamians fly more often than you would imagine. Okay? We say things are tough, we broke, we don't have any money, God must be cursed me and all kind of stuff, but that doesn't stop us from flying, at least from here to Florida. At least for some people, sometimes weekly, they say. I don't know how that happens, but a lot of people fly around quickly, often, despite, so I guess we like that movie on TV, The Haves and the Have-Nots. Anybody who knows that one? Nobody
Yes,
watches Tyler Perry's Have and Have-Nots?
every now and again.
Yeah, okay. So Natasha, since you watched one or two episodes, what's the big deal with that? Why are people watching it?
I actually stopped because that was too much drama and trapsiness.
Drama and?
Trapsiness.
Oh, now I like that word, but some of us may not know what that means. When you say trapsiness, Natasha, you mean?
They being messy.
Yes, exactly. Too much egg. That's messy. Behind the scene, double crossing, underhanded. Yeah. The only problem with that is if only it was just a movie, then you could say what? It's just a movie. The only problem with that stuff is those things happening in real life as we speak. Isn't
It's
that
so
amazing?
real.
Yeah, it's happening all over the world in real life, in real time, with real people. That's fascinating. Yes, absolutely.
And the sad thing about it, garbage in, garbage out.
Yes,
You don't want to take in that garbage.
exactly. That's the saddest part. And what's even sadder than that? Millions of people are watching it and taking in the garbage, and some of them are actually consumed by it, which is why it's still on TV for some reason. Things like that, not just that one, and all the other stuff connected there too. Absolutely. Absolutely. You wonder how in the world people have the time to get caught up with all that trapsiness. Like I like that word. Okay? Because it's a big old headache, actually. All right. So you can see right away how these like gift certificates, how frequent flyer miles can become a nightmare for airlines to estimate. They can only do their very best based on their algorithms, their historical trends, what has happened in the past, and so on, to say, okay, we have 10 billion of flyer miles out there based on our estimates. We anticipate that 1 billion will be used up this year. Are they right? Nobody knows. Nobody can tell. It's only an estimate based on history and numbers and calculating it and so on. So we come up with a number eventually, and then whatever we estimate that number to be, we debit to frequent flyer expense for that year. And that's the best we can do. Now, if 2 billion people come in, well, then we just have to adjust the accounts for the additional billion that we underestimated and move forward. The key is to come up with something that makes sense. Don't say like, that's my gut feeling. The CEO can't say, well, We chose a number because it was a gut feeling. We don't want to do the gut feeling thing. In accounting, we don't deal with gut feelings. That's what we call guesstimating. In accounting, we estimate, and estimates are based on some kind of foundation, history, averages, trends. See, that's what accountants deal with, not gut feeling. Okay. So, in the Midas example, we see how Midas would handle their warranty. If they decide they're going to give a warranty to their people, nobody knows how many people are going to, Midas doesn't know how many people are going to come in to use that warranty. So they can only estimate in any particular year. Half may come in that year, a quarter may come in, everybody may come in 1 year, God forbid. We don't know as a company. So in any particular year, as long as warranties are outstanding, we have to estimate. Okay? And so this example then that they gave us is, what does the $2,100 represent, you think? What does the $2,100 represent? Anybody figured it out? Like, why do we have that number? Why do we debit that number to product warranty expense?
Assume that, and this is really just an estimation,
Uh-huh.
but I assume that the $2,100 represent the value of the product, just in case the warranty needs to be used. Like, let's just say I buy a fridge. I don't know what Midas is, but let's just say I buy a fridge from Midas for $2,100, and he
Right.
give me a 1-year warranty, and then I say, my fridge stopped working in 6 months time. He got to replace my fridge, which is $2,100.
Indeed. If that's the arrangement, then that is exactly what the $2,100 would represent. And again, that number would change depending on what the item is, what the estimates are, etc. But generally, that's how it works. And so what happens is the company that gives a warranty is actually establishing a liability for itself. But it takes the risk of establishing a liability so they could get your business. Do you follow? And they're hoping that the product or products that they're selling will hold up for the most part, and that not too many people, if any, will come back to redeem or make a change for the product. That may be much to hope for, but in most cases, warranty periods expire and only a few people might come in to change something. And so the company has to come up with an estimate as to how many people might come in and what dollar amount that represents. And they do that so that they can put an expense amount in their current financial year for persons who might come in that year. Okay. Uh, Again, it's an estimated liability. We cannot know the exact number because we do not know how many people will come in and we do not know when. Okay? So in this example, Midas says, okay, we're going to estimate our liability to be $2,100. Based on our calculation, we do not anticipate that more than $2,100 worth of claims will be made this year. And so we will set up our accounts based on that. And as such, they debit their product warranty expense account for $2,100, which they expect to pay out. Will it be $2,100? Midas or nobody else knows. They just have to wait. In the meantime, though, we need an accounting record for that year. So we debit product warranty expense at the end of the year for an estimated expense, and then we credit a liability account called estimated product warranty liability. Okay? Now that liability will stay there until somebody comes in to exchange something. But before that ever happens, the question must be, how is it that this $2,100 is determined? Did we just pull this out of a hat? Did we get it from the numbers boys or what? How did it happen? Well, we have a little calculation at the bottom of how it happened. Just to give you an idea of the kinds of things that accounting departments consider in coming up with these liability estimates. Okay? So let's look at an example. This company, Midas, which is a muffler company, by the way, they install mufflers worldwide in many instances. But Midas determines that, all right, that year they're selling 700 units. Based on their experience in the past, they usually have to replace under warranty 6% of all sales. So now what mechanism are they using? They're using past experience. Okay. And so based on their history, they can go back into their records and say, roughly every year, we change or we replace under warranty about 6% of our sales. And so they use 6% for the current period. 6% of 700 units is equal to what? Six percent of 700 units is equal to what?
42.
Yeah, 42 units. So Midas expects that 42 units will be exchanged under warranty this year. That's their estimate. Now, we can't put 42 in the accounting records because the accounting records can only take dollars, nothing else. No machine, no trees, no rabbits, only dollars. So we have to convert the 42 units of mufflers to dollars. How do we do that? How do we do that? How do we convert the 42 units or mufflers to dollars so that we can put it into the accounting records?
Multiply it by the cost of each unit, which is $50.
Yeah, we multiply the 42 units by the cost of each unit, which is 50 bucks, and that gives us, voila, the $2,100 in warranty expense. So this is kind of to introduce you to the way companies deal with these estimated liabilities. As you can see, there are a lot of little bits and pieces like any other profession, which is why persons cannot just walk into an accounts department and assume that they are accountants. It doesn't work that way. All of us who are going to do any level of bookkeeping and accounting have to go through all of this torture so that we can learn all the different methods and techniques to do all these different things so that we can report correctly in the financial records. Because if we're not trained properly, first of all, we won't know what to do. And secondly, we are going to mess things up tremendously. Sometimes even trained bookkeepers and accountants mess up from time to time for one reason or another. So clearly, it takes time, classes, many more classes, and homework and more homework, and pain and suffering, and all these other things like any other profession to learn these things so that we can do this work correctly. Okay? Which is why if you go into an organization or you go into an entity, sometimes business owners like to act like the accounting process is a by the way thing because they really don't understand it. They don't want to deal with it. They don't know what's going on. And most of all, they don't want to pay to have it done. So oftentimes, especially small businesses in the Bahamas, the first thing they'll tell you is they don't need no stupid, stinky accountant. Some of them. And those who are forced to get one often treat the whole thing with disdain because they don't understand it and they don't get it. All they know is they have to pay money. And they'd rather go to Miami, again, than pay money to get their financial records and keep them in order, unfortunately. All right, any questions so far? Great, because you can ask a question anytime. Now, we see how companies estimate for their warranties. We see how they estimate for real property tax, income tax, and all that good stuff, frequent flyer miles, gift cards and so on. What about this other entry right under Midas? Something happened after the estimate is done by Midas. What happened? Can anybody look at the transaction and say, like, what happened? What is this next thing that happened in Midas after they came up with the product estimate expense for that year? What does that journal entry tell us happened? Did something happen for $60 and $30?
The customer returns a defective muffler.
Okay. After estimating what the returns will be, yay, one person came back so far. That's really what happened. Now, one person came back to change the defective muffler, and two things happened. Can anybody say the two things that happened when the person came to change the defective muffler? Actually, the reason why journal entries are set up the way they are, and it comes with practice, is not an overnight affair. Those of us who've been practicing accounting for a while, at some point we can just look at a journal entry, even without reading the narrative, and see what happened. Some of us who are not really good at it yet, even if we read the narrative, we still don't know what the hell happened because we're not good enough at it yet. But typically, once we get in the groove, we can look at an accounting journal entry and say, oh, this is what happened. What do you think happened with this 60/30? This is what we call the analytical side of accounting, looking at stuff and drawing from that what happened. What happened in this case? If you need to guesstimate, that's guesstimate is better than no mate. Guesstimate, even if you cannot estimate what happened. What do you think? Well, what does the $30 in cash represent?
That's the service fee that was charged.
Okay, so now we have new information, correct? When they were doing the estimate for the warranty expense, that $30 fee did not come up in that discussion because it was not relevant to that. At 2,100 that we were estimating, we were just estimating to see how much we were going to pay out overall based on our history. Now, we have additional information that every time somebody comes in to replace a defective muffler, two things has to happen. One, they have to pay a $30 fee to replace it. Isn't that smart, Midas? So, okay, doggone it. We sold you the defective muffler. Great, bring it back in the warranty. However, we're not replacing it. What? Hello? If you guys are making your hard-earned money and you're returning something under warranty, and they tell you there's a $30 replacement cost, so that make you happy? Would you say yay?
No.
No, what would you say?
Why do I have to pay?
Thank you. This is under warranty, Mr. Midas. No wonder they call you Midas, because you're cheapskate. By the way, that's King Midas was a cheapskate, by the way. How the hell you could say this is under warranty and then charge me $30 to replace it? That means that they're collecting what? Money back on the money that they're losing for stuff to come in under warranty. Do you see that? Do you see that, folks?
Yes.
Because if you don't see it, you're going to spend a lot of money that you shouldn't be spending in your lifetime. Especially poor, hardworking people. If you're rich, it doesn't matter. They don't need to see anything.
Yeah, because this cash wasn't making sense to me. Why are they receiving cash if it's under warranty?
That's my point. If it's under warranty, why the hell are you charging me $30 to put in the new muffler? That's how they make money back, remember? Companies do it all the time. If the government says to super value that you cannot charge more than this amount on this particular product, what do you think super value will do if they can't do that?
To raise the price on others?
Of course. See how it works in the real world?
So, Mr. With this, sometime company outright charge you extra for the warranty.
If they'll charge you outright for the warranty,
Some cases, there's an extra charge fee for warranty.
sometimes they'll do that, but they wouldn't say there's a fee for the warranty. They wouldn't say.
No, they'll just hide it in the cost.
Yeah, or say it's a replacement cost. Like this $30, one or the other. Absolutely. Either way, it's stinky. If you're under warranty, then you're under warranty, the company should absorb the whole cost. Correct? Not charge you to replace it. What the hell is that? But it happens all the time. So the $30 is the charge to replace the muffler under warranty. And why do you think we debit $60 to estimated product warranty liability? Why?
Wasn't that the replacement cost of the muffler?
Yes, the replacement cost of the muffler is $60, and so we have to debit the liability account for that amount, which means that the company's liability to you now is extinguished. It's gone because you came in, they exchanged the muffler for you, and so they're no longer liable to you, the individual. There are others out there, mind you, that they're hoping will not come in, but you've come in. They have extinguished the liability to you by debiting the liability account. But now the transaction for accounting purposes is not done with those two debits. What about the two credits? What do they represent?
The cash received for the muffler? For the replacement muffler?
Well, remember cash received in accounting is always a what?
Debit.
Exactly, which we've already accounted for.
So it will be
that's-
the second one. Okay,
Yeah,
the reduction in
credit side.
inventory.
Well, what does the $30 represent first on the credit side?
The reduction of inventory?
Mm-mm,
No, merchandise inventory,
mm-mm,
I
not the
don't know.
$30.
$30, merchandise inventory, what is that? I don't know.
Now, you're right. The reduction in merchandise inventory is part of this entry, but it's not the $30 part.
That's the service party.
It's the service revenue. Why do we credit service revenue for $30? Clearly, you guys have not yet been business owners. You'd know right away. But one of these days, when you open up your own business, for some reason, some of you'll say, "Oh, I'm so happy I took that cost. Now I see why we credit
Yeah,
service."
that's because they charge the fee for the service, so the revenue would increase,
Yeah, they did. They charged $30 to put it in.
right? So that's
So
why
that
there's a credit.
Yeah, their revenue went up by $30 because they charge an extra fee. Do you follow?
Yeah.
Let's say, for example, you own a dress store and your original selling price was $300, God forbid. When you sell that dress, what entry are you going to make? You sold the dress for 300, a little piece of material from here to there for 300, because you're probably overcharging them anyway, but the girl likes it. I like that, look at me, make me look something. So what entry would you make?
If you sold a dress, you'll debit the cash and you'll credit the merchant inventory.
Correct. Well, not inventory. We do debit cash for 300, but what do we credit? Not inventory,
Revenue,
revenue. Always, every time you sell anything, even if you sell dope, marijuana, cocaine, whatever, God forbid, if you're running a business, anytime you sell something, the credit side is usually revenue.
Okay.
Especially,
But
okay?
that's, you'll have a double entry for that because the inventory is reduced as well.
Indeed. Only if it's a merchandising enterprise. If
Right.
if it's a service business, will you have inventory?
No, depends on what you're dealing with.
Correct. But in the business that you're in selling products, yes, it would be a second entry. And this is why not any Tom, Dick, and Harry can walk in and say they're doing your what? Accounting records. Because if they've not studied this stuff, they'll not know what to do when or why. Okay. So when folks say that their fee is X, just pay them the fee if it's reasonable. They didn't buy their information from a tuck shop. All right. And so, yeah, we credit service revenue for the $30 that we made for putting the muffler in. And then what do we do with the $60? Why do we credit that? Anyone? Why do we credit the $60? To merchandise inventory.
Because you're replacing the muffler.
Yeah, you're replacing it,
So
meaning
you're
what?
reducing the inventory then.
Absolutely, absolutely. When you replace the muffler, you are reducing your inventory for mufflers by 1, correct?
Mm-hmm.
And the only way you could reduce it is by crediting merchandise inventory. Because when you bought those mufflers, what account did you debit for the inventory? When you bought them,
You would have debited the inventory account.
the same merchandise inventory when we receive them into our stock. And so if one is going out, the only way we can reduce the merchandise inventory account is by crediting it. All right. So that, in case you're wondering, like, why do you have to suffer through all this stuff? Well, that's why, because you have to learn this crazy stuff. As you can see, this isn't just pop in your head, like, wow. All right. So there you go. In the first journal entry, we show the estimated expense that the company determines based on its history that they expect that they will have to pay out or incur in terms of their liability for the warranty. And then the second journal entry shows what happens when somebody comes in to claim a warranty, how the company actually accounts. If we don't do it exactly this way, the accounting records will be incorrect. I can't put it any other way. You either know, you can do it some other way, but the records will be wrong. That's my point. And sometimes people do it another way because they don't really know the correct way. And sometimes they don't even know where to go to look for the correct way. And sometimes they don't go to somebody else to ask them about the correct way. And sometimes the person they go to about the correct way who should know doesn't always know either. I know, I confused the issue. That was not the intent. The only point here is these are the two journal entries that we use under warranty accounting. Okay? So if that crops up in your homework for some reason, you wouldn't be stuck anymore. Because now what we've done, dissected it. Just like when you're dissecting a rat in a lab. So you can see people in labs are not the only dissectors. So are accountants and accounting students. We're dissecting transactions all day in class, don't we? Because that's what accounting is all about. Taking information and situations and dissecting them, analyzing them, and then coming up with hopefully the correct result so that our financial records are accurate, correct. All right. Thank you, Natasha. Let's see who follows you. Andrika, are you there?
I am here.
Fabulous. Do you see that heading that says vacation pay liability?
Yes, sir.
Great. Why don't you start there?
Okay. Vacation pay liability. Can you guys hear me?
Absolutely. Very well.
Okay. In most companies, employees accrue paid vacation as they work during the year. For example, an employee may earn 52 weeks salary for 50 weeks work. The cost of the 2 weeks vacation should be allocated as an expense over the year so that month-to-month costs will not be distorted. The vacation pay represents 4%, 2 weeks vacation divided by 50 weeks of an employee's pay. Recording vacation pay expense transaction. Tiffany Company has a vacation policy of 2 weeks of paid vacation for each 50 weeks of work. Has a payroll of 42,000 and paid 2,000 of that amount to an employee on vacation for the week ended April 20th. Because of the past experience with employee turnover, the company assumes that only 75% of the employees will ultimately collect vacation pay. The computation of vacation pay expense based on payroll of employees not on vacation is as follows. 40,000 times 4% times 75% equals 1,200. Tiffany must record vacation pay expense for the week ended April 20th.
Okay, now we have another journal entry or two again. So you can see the life of the accountant, bookkeeper is filled with journal entries, and it should be the life of a nurse is filled with needles and nurse stuff. The life of a banker is filled with KYC documentation, processing loan payments, and getting people to bloody repay the loan. The life of private banking is Cheryl, what's the life of private bankers these days?
Let's not say money laundering.
Okay. And Cheryl can say that because she is a private banker, and therefore the point is made that every profession has its thing going on. The good, the bad, and the
They
ugly.
try now. They try.
Every time. They're never going to stop trying. Ever. Okay? That's why the quote unquote good guys are constantly trying to find as many ways to keep things under wraps as possible and to minimize the success of persons who are continuously trying to get around the system. Some of them still do. They still get to pay off people who will take a risk and all this kind of stuff. They still get some banks who are so big that they cannot fail to do stuff. And then when they get fined by regulators, they just pay the fine and so on. So yeah, the good, the bad, and the ugly. But for the most part, in Cheryl's part of the world, we try like hell on average to keep the bad guys at bay. Just like good accountants like will try as much as hell to keep financial records complete and accurate, such that any CEO, CFO, or any other person who comes along to suggest that they should do any kind of hanky panking, that the accountant, financial controller, chief of financial officer, whomever they might be, will say, just like Cheryl and company, sorry, I'm not going to do it. Find yourself another guinea pig who will take your payoff or your incentive to do it. All right, again, that's an ethical issue again. But ethics, like accounting, is everywhere. Everything in the world is subject to some ethical issue, by the way. Accounting is no exception. Private banking is no exception. Let me see what the other professions are. Domestic banking, like Scotiabank and Commonwealth Bank, is no exception. Central bank, Jerry is, especially because there are a bunch of regulators in there. So they're always looking for banks in the Bahamas who are trying to hanky pank.
No, the key to that is to have effective internal controls, though.
Indeed. And the greater key to that is to have ethical people who are
Right.
doing the work of internal control or any other work for that
True.
matter.
The key is your personnel as well.
Absolutely, trying to keep your personnel ethical. Once the second thing under that, because that is so difficult to manage sometimes, is yes, internal controls are there so that even if you are unethical, it'll help the organization to catch you, so to speak. All right, done it. But yeah, so much hinges on our people. So much hinges on our people. Okay? All right, because what our people do will ultimately determine how successful our programs and controls are. So important. When my children were growing up, I would always tell them from time to time, your daddy, your father is not interested so much in what you do when you are with me. Because I know that when you are with me, you're going to be on your best behavior because you know that I will not tolerate anything less. My concern is what you are doing when I am not around.
Yep.
And the same thing applies across the board, wherever we are. What are our employees doing or people doing when authority is not around? Okay?
That's what they say. You are who you are when no one is around.
That is the key. Nobody is tested when people are around. You're only tested when nobody's around. Absolutely. I tease my wife all the time. She says, you're not afraid somebody's gonna run. I'm like, no. If I have to run around watching you, then I need to pack up my Georgie bundle and leave.
Too much headache.
Because you cannot watch anyone 24/7, can you?
Nope.
No. I have to rely on her own integrity. I have to, because I'm going to be to work. I'm not going to be there 24/7. I can't watch anyone, even my own children, whom I love dearly. That they're the hell gone now. And if I didn't lead them with the proper things, and I still have to hope that they do it, because I can no longer watch them now at all. How about that? So this thing is the same principle. That's what I'm saying. The same principle. We have to rely on our people primarily, and first of all, to do the right thing. And so we do everything to encourage them to do that, even though we know that sooner or later there are always a couple of thingamapples. All right. So in this crude liability example, where did the $1,200 come from again? Anybody? Did it just crop up? Did we guesstimate that?
No, we calculated that.
Yeah, we calculated that. Now notice the calculation very carefully.
Yes.
Okay. Does everybody see the calculation? Because that's important. I think this
Yes.
is the homework question, so be careful with that calculation. It's what does the 42,000 represent? What is that?
The annual salary.
Yeah, the annual salary, and then we subtract from that.
I guess the vacation.
So 4% of 42,000.
Right.
Does that give us 2,000? Do you believe everything the book says?
Book should be right.
It should be, exactly.
Okay, let me take up my calculator.
Oh, excuse me, I'm sorry. I'm happy somebody said the word calculator. You need a calculator for every accounting class, and you definitely need them for your midterm exam and your final exam. Otherwise, dog eat your lunch.
Actually, I didn't get that.
I know you didn't get that. That's why we cannot presume. So if you didn't get that, where did it come from?
So the $2,000 was paid to the employee on their vacation.
Oh, 2,000 of the 42,000, of the 42,000 was paid to employees on vacation for that particular week ended April 20th. So since that employee has already been paid, then we cannot include them in our estimate. Do you see that, folks? The answer is slow in coming. Because an employee has already been paid for 2,000 who just went on vacation, we cannot include them in our liability estimate at the bottom.
Right. So we have to reduce that 42,000 by
By
2,000.
what has already been paid.
Mhm.
Otherwise, if we don't, then the liability estimate at the bottom will be wrong.
We overstated.
Yes. Doggone it. it will be overstated. So anybody who's been paid on for vacation when you're doing this estimate, that figure has to be taken out of the overall figure. So we end up with 40,000 times the 4% times the 75%, which raises another question. Where did the 75% come from? Where did the 75% come from? So this is what I mean by accountants dissect all the time. We have to always be looking at the details. That's why we are told that accounting people need to be analytical, because you have to always be looking at details like, where the hell did that come from? Where did that come from? Like AML, like compliance officers and MLROs. Where did that come from? Who did that? Why did they do it? When did they do it? Who did they do it for? Why so often? And so on. So where did the 75% come from? Remember, when anything's not obvious, go back to the narrative. What does the narrative say?
Well, the company assumes that 75% of employees will collect vacation pay.
Yes. And they assume 75% because why not 100%? Why is it 100% will not get collected vacation pay?
Well, it might have a high turnover.
Yeah, some people leave. That's what we're saying. All right. And so when we're making estimates about vacation liability, we build in there the average person's number of persons who might leave. How do we know it might be 25%? We don't know for sure. How the hell we know what people are going to do? I don't even know if I may be talking to you and then 5 minutes from now you may not hear anything. What could have happened to me?
The internet is lagging.
Or
Well, I'm going to go with the most optimistic option.
which is?
Which is, the Zoom call dropped.
Or remember, you have to think of all the variables. You don't hear me anymore. So the internet went, or the Zoom code dropped, or the one that we never like to think about, which is the obvious. I just died at the computer. How's that?
I would never say that.
I know. And I appreciate that completely because I'm hoping that doesn't happen. But we know worst case scenario, it could. Crap happens all the time. Okay. But the point I'm making is that is so sweet. So never say that. The point is when we're doing these estimates and accounting and other stuff we're estimating, in this case accounting, we look at all these variables. Okay, why is it that only 75% of persons may take vacation pay? Because 25% will not get vacation primarily because of they're not there. Turnover, they've left. Do we know exactly how many people leave in a year? No. How do we come up with an estimate? We look at how many left the previous year, how many left the previous 3 years, see? And we use those numbers, those trends to help us come up with a 25% rate of persons who will not get vacation in a particular year. All right, good stuff. So now we know the $1,200 didn't just show up. Once we do our calculations, then we can estimate our vacation expense liability for as at April 30th. And it looks in this case, since the amount is so small, that we're calculating this liability month over month. Okay? Some organizations do this on an annual basis. This appears to be a month over month basis because the amount is so small. So for the month of April, we anticipate that our vacation expense bill will be $1,200, and our estimated liability for vacation pay will be $1,200. Let's say in the next month, we discovered that the vacation expense is actually not $1,200. It was something more or less. What do we do in accounting when that happens? We just make an adjusting entry. Remember that word? It's not a dirty word. It's a very common word in accounting. It's a very important one. If something doesn't work out to be exactly what it's supposed to be, we make an adjusting entry in order to correct it. Okay? That's all we do. So in the next period, when vacation pay is paid, if it's 1,200, we debit vacation pay liability for 1,200, and then we credit cash for the 1,200 that we actually pay out. Now, what is this other transaction for 2,000? Is that the same 2,000 from earlier? Or is that something else? Well, it's an extension of what happens once the employee is actually paid their vacation. Remember, we took out the 2,000 from the 42 because that's the person who went on vacation. This journal entry is the entry we make when they actually get their vacation pay. Like they say, excuse me, I'm on vacation, I don't see my money in my account. And somebody forgot to process it. Okay, so they send the money to the employee's account, and then in the accounting records, that transaction has to be recorded. How do we record it? Simple. We debit the estimated liability for vacation pay account for $2,000. And what do we credit? What do we credit?
Estimated liability for vacation pay.
Well, we debit estimated liability for vacation pay.
That's for the 2,000.
Yeah, what do we credit?
Oh, we will credit the cash
Yes, we credit
because they're
cash
paying it.
because we're actually paying it. Absolutely. Okay. As a matter of fact, cash transactions should always be the easiest to record in accounting. Whenever we receive cash, we debit cash. Whenever we pay cash, we credit cash. That's it. It's a no-brainer. If you're still trying to figure out how to record cash transactions coming in and out, I wouldn't say anything is wrong. I would just say that you should practice it a little more. That's one of the easiest transactions you'll ever make in accounting. Cash coming in, debit. Cash going out, credit. Okay. And that transaction is to show the actual payment that is made to the employee who went on holiday. As you can see, the estimated liability for vacation pay account is a running account. Every month, we estimate and we put an amount in there. And then when we make vacation payments, we debit it for the actual vacation payments. So the estimated liability account will always be going up and down during the year until the end of the year. And then we see exactly what is left in the liability account to see how much vacation is still owing to employees. So that particular account is likely to be an ongoing liability account, depending on a particular organization. Okay? Because it's hard to tell how many people will go on vacation in a particular year and when. It's hard to tell who will leave the company and when. So we just do these estimates. And then when we come up, when somebody actually goes on vacation, we will then go ahead and record the transaction. If somebody actually leaves, then we'll make the adjustment in the estimated liability for that person who's left. So that liability account is likely to be going up and down throughout the year. Okay. Do you guys have that stop and apply with identifying definitely determinable liabilities? Do you have that? Fill in the blanks.
I don't see it, but it might be here.
Anybody sees it in your business thing? Identify cash, to identify each of the following as either definitely determinable liability or an estimated liability.
That now.
Okay, if you don't see it immediately, I'm going to say it and I want you to tell me whether it's a definitely determinable liability as per our discussion or an estimated liability. All right, here we go. Bank loan.
Definitely determinable.
Yes. If somebody does not agree with somebody or me, say so. Like, I don't agree. And then we'll say, what do you think? And that's what I think it's the other one. And then we'll see who's correct. All right. What about dividends payable?
Estimated. That's an estimated liability.
Dividend payment?
Yeah, because it's based on income, right? Net profits.
Well, yeah. Actually, your answer is not completely right, nor is it completely wrong. Here's why. Dividends are only paid when the board of directors make a declaration. So if the board doesn't make a declaration that they're going to pay, then there's no liability. However, once the board makes a declaration and puts it in the minutes of the resolution that the dividends will be paid in any particular year, then it becomes definitely determinable. Okay? And the reason why it becomes definitely determinable because they've made the declaration, you can't take it back. All right, and usually that declaration will include how much will be paid per share. So the board will say, as at August 31st, we'll pay a dividend of 3 cents per share, which doesn't help the person who only has 500 shares. That's not a lot of money, but they're going to celebrate anyway. Yay, I'm getting some money, a small check or whatever. If you have 500 shares in Commonwealth Bank and they declare 3 cents a share, how much will you get? What will your check be?
Whatever 3 cents is times 500.
I like that.
Okay,
And so what will your check be?
that's $15.
$15. Is that good or bad?
I mean, you could buy a bamboo
Buy lunch
snack,
for one day.
You could buy what?
a bamboo snack.
Lunch.
Yeah, you could buy, depending on where you go.
Buy lunch for one day.
Depending on where you go, you could buy lunch for 1 day.
That's more than NIB gave that man who was on the news. He got 14
14 what? $14?
what from NIB.
For what purpose?
I think it was unemployment benefits.
$14?
Yes, he stood on the line. He stood on the line for hours just to get $14. That's when the pandemic first started.
I know that there must be something criminal about that. How did that happen? And how come there's
I
only $14?
I
I
don't
don't
know.
know.
Shoot at you.
Even if he didn't make any contributions, he shouldn't get $14.
But to stand on a line and wait so long for $14.
Yeah, that's a tragedy. And if I had time, I would investigate. But nobody really seems to care anymore with too many things, so I can't take the time. But that is a tragedy. It's a tragedy that I hope that somebody has corrected somehow. That along the way, right? That's totally crazy. The same tragedy that when somebody gets unemployment pay, instead of going home and looking to see how they can stretch it to feed their families, where do they go? Where do they go with the unemployment money?
The web shop.
The what shop?
The web shop.
Yes, the web. Did you ever think about why we call it a web shop?
Because it's a net. It catches you and don't want to let you go. It's a
Absolutely.
trap.
Whatever other reason they give for calling it web shop, definitely that is one of the reasons by direct implication. It's like being caught in a web. And if you've never been caught in a web, thank your lucky stars. Love web, gambling web, family web, whatever the web is. Because once you get in a spider's web, the more you wiggle, what happens?
The tighter it gets.
So the only solution is to stay away from the
Web
web.
shop.
Any web, web shop included. All right. I drove past the web shop in Foxhill yesterday, coming home out of the eastern area. And tons of cars were parked up comfortably, like they were parked in such a way that it was evident that they were not going anywhere. anytime soon.
Mhm.
And I'm thinking, what the hell are they doing in there? I've never even seen I haven't even opened the door of a web shop yet out of curiosity. But I'm thinking, what the hell are they doing? I'm rushing home. I'm anxious to get home, put my feet up, and say, thank you, Jesus, the end of another day. They're parked in front of a web shop neatly. Every car parked neatly, one by the other, in what appears to be a fairly permanent position. Like they're not leaving there anytime soon.
Gotta make that dollar.
Is that making money?
I hope so.
I guarantee you they're not. Remember, I told you gambling is designed for most people to lose and only a few people to win. And they only allow a few people to win so that everybody could keep coming back thinking that they will. Whether it's a web shop, a casino, or any such thing, even when you buy from the lottery.
I guess they hope they're part of that 1% of to win daily.
And that's what keeps everybody going back. And that's why lotteries work for a handful of people and not for most people, including web shops and casinos. Okay? It's a sad truth, but they have figured people out because of our desire to win. They get rich and filthy rich. And only a few of us actually win anything substantial. But the desire to win, see, desire. That's why if you don't have any desire to study, notice what happens. You don't study. And if even if you do, you hate it. But if you have a desire, oh, I love this studying. This homework Mr. Wilkinson gave me is just fabulous because I have a desire. Okay. Number 3, product warranty liabilities. Which one is that?
That's estimated.
That's estimated. Yes. Interest payable. Interest payable.
That's estimated, right?
I hope not. Because when you go to the bank, they tell you interest rate is.
And isn't it calculated? I'm thinking estimated is something that's not fixed. The interest amount based on
No,
the
it's not.
balance.
I see what you're saying. No, it's not.
Maybe I'm confused.
No, it's not based on whether it's fixed or not. And even if you are a little confused, it's okay because it is a little confusing even for people in practice. Okay. Remember, if you go back and look at the definition of definitely determinable and estimated, that's definitely determinable will usually be based on some number or situation that's already predetermined. An estimate is usually based on some situation you cannot determine. So if you have an interest payable, that means you've had somebody gave you an interest rate, right?
Right. So that's determined.
Yes.
Okay.
Yes, absolutely. What about income tax payable? Income tax payable.
I would say that's determined too. Definitely determinable.
By who?
I would say.
Well, you'll find that that usually falls under estimated because the company, remember, all of these are from a company's perspective. And the company cannot determine what the government's estimated tax bill is going to be until next year when they get the bill from government. So because they cannot determine it in advance, it's then therefore remember, if a transaction cannot be determined or is not known in advance, it is estimated. If it is known or determinable in advance, it is determinable.
Why won't a company know what will be their income tax?
Because the way that companies calculate income tax is different from what the government method is.
Yeah.
And as a result of that, they will never know the exact number until the government sends the tax bill. Because the government usually uses a different tax method from companies. That's a whole different aspect of accounting called income tax accounting. But for the moment, typically the government methodology is different from the company's methodology of calculating income tax. And because of that, the exact bill is never known until the government sends it to the company. And therefore, for the company, they can only
Estimate.
estimate. Okay.
So how is that different than declaring dividend?
Because when they declare dividends, they say we're going to pay $3 a share. There's no doubt there. It's clear.
Oh, just on the share base. Okay, it's not on an income basis, on the share basis.
Oh yeah, dividends are paid per share, not by income. It is
Oh,
paid. It is,
okay, some companies would pay by, yeah,
no, it is
depends on the
paid,
net profit,
yeah, it is
the
paid.
percentage value.
Yeah, they decide to pay based on whether or not the company is profitable enough or not. However, when the declaration to pay is made, it is based on a per share basis. They will say, we will pay 3, 5, 10 cents, $50 per share. Okay, so that is known in advance.
Okay.
Yes. Okay, good point. I'm happy you keep bringing it back so that it makes it clearer and clearer, because the more you question it that way, see, we're analyzing it again. So we keep breaking it down, and then eventually, I see what this doggone estimated versus definitely determinable thing is. And I can see why there are some gray areas. Okay, for sure. What about vacation pay liability? Estimate or determinable?
Estimated.
Absolutely, we just did that one. We can't tell who the hell is going to leave, can we? So
No,
it's estimate. Notes payable.
Definitely determinable.
Yes. Why?
Because the bank or whoever we have the note from, they let us know what the liability is at the
Absolutely.
inception of it.
Absolutely. There's no doubt about it whatsoever. So therefore, it's determinable. What about property taxes payable? We just
estimated.
Yes, way to go, Cheryl. So you're not gonna get me on that one. I know that one. That is estimated. All right. Commercial paper.
That's definitely determinable.
Yes, that is similar to a note of some kind. It is
Mm-hmm.
definitely determinable. Way to go. And then finally, the gift certificate liability. What is that?
That's estimated.
Yes, because we don't
You don't know who's going to redeem it.
know, nor when for that matter. Somebody might show up 20 years later, like, I just found this in my stuff. Can I still get
That
something?
ain't gonna work. Most of them have 1 or 2 year warranty.
Yes, they put limits on them for obvious reasons, because people will be coming in, giving it to their grandchildren and leaving it in their will and all that stuff. People coming 30 years later, the company isn't even there anymore. So yeah, they put limits on them, time limits, so that people can come in reasonable time and they can get rid of that liability. Folks don't want a liability hanging over their heads, man. Indefinitely. All
You
right.
got to get them off the
Get them
books.
off the books as soon as possible. Just like our own personal lives. When we have debt, except for our mortgage, which stays with us until death. Mortgage is like being married. Until death do us part. Some of us live long enough to pay off our mortgages. Yay. But some of us, our mortgages, we die and leave our mortgages, which is okay too. Let somebody else deal with it. The point is, uh, which is not a bad idea, by the way.
I was thinking about that. No, the one who inherited, let them pay it off.
Or see, let me tell you a little secret for free. Okay, because the reason why I say for free is because I do consulting services for a fee, actually, in business and all this crap, compliance with MLR, or any crap like that, accounting. I do all that nonsense whenever somebody calls me. But what I'm saying is, uh, that thing about leaving the mortgage is also, see, we have this notion for some reason that we should pay off our mortgage before we die. And that's okay. If you could pay it off before you die, then pay it the hell off 10 years later, which is not realistic for most of us. 20 years later, which some of us can do. 30 years later, which some of us get away with every now and then. But some of us, depending on when we get our mortgages, we're not, we fight to pay it off. Like, I'm gonna pay more. I'm gonna pay this off before I die. So why? You have to pay it off before you die. Just enjoy the house and pay a normal fee mortgage that you could afford. And then if you have $100,000 balance, $150,000 balance when you die, fine. Let your heirs finish paying it off. Shouldn't they pay something anyway?
They
For
will
the
get it
luxury,
scot-free.
yeah, for the luxury. Why the hell should you pay the whole thing? You should save some money and go to Waikiki and just pay a smaller thing. And then whatever left, let them pay it off. And if they don't pay it off, that's their business. Because we already dead. Okay? Not only do they have the option to pay it off, they can also what? Sell it if they want to and pay it off if they don't feel like making payments. See? But my point is, let them worry about that. You
Now,
pay
Mr. Wilkinson, you know why people pay it off? They try to get rid of that expense prior to retirement.
I know. But you ever heard about something in the US called reverse mortgages?
We don't, what is that? Reverse mortgages?
Yes.
I heard of that. That sounds interesting, but we don't have that here, right?
No, we could, but we don't yet. Because sometimes what reverse mortgages do, it allows people to be able to make an affordable payment, live in their house, and then when they die, something happens, the bank sells it, family members sell it, whatever.
Yeah,
But
get their funds then.
yeah,
Yeah.
but we don't like to do that because we want people to like suffer and pay it off. And we
Yeah, that's a good concept.
it is actually, and I'm giving that serious consideration. I said, let me see if I can get my mortgage payment down to within my retirement payment amount. So then after that, the hell with it. So when I found if my sons and my wife and company don't want it, then see like that. But the thing is, if you could pay it off, knock yourself out. But I'm saying if you find yourself in a situation in your life because you're older, you got ill and whatever the reason, and you only can pay a fixed amount and you can negotiate that and pay that. And who don't like, then whatever the balance is, let them pay afterwards. And if they don't wish to pay, no problem. They can put it on the market. In the meantime, you would not be suffering in your life trying to pay it.
Enjoy your money while
Thank
you have
you,
it.
Cheryl. Way to go.
People want double up and pay off that
Pull up and all
mortgage.
that
What you
nonsense.
doing that for?
Oh, thank you. At the end, thank you very much. And at the end, to prove what? And who gives up? Can't say that on TV. Yes. All right. So little food. Well, youngsters don't get that yet, but Cheryl get that. And the youngsters who are in the group, they might get it later if they don't get the payoff for things beforehand thing. Okay, they'll see the benefit of that. There's great value in that for those of us who can pull that off, especially given our very unique circumstances in this decrepit life sometimes. All right. So who was reading? Andrika. Andrika's reading for a while. Okay, a little bit more, Andrika, then we move on. Continue.
Okay,
Do you see contingent liabilities and commitments?
I'm checking. One moment.
Yeah, where did you stop the last time? Pick up right from that point. We stopped at the journal entry, whatever is after that. It
One
should be
moment.
contingent liabilities and commitments.
Contingent. Oh, yes, that's what it is.
Okay, let's read a little bit more and then we move on to Cheryl, I think. See if we can
Okay.
get Cheryl before the day is over.
Contingent liabilities and commitments. The FASB requires companies to disclose in a note to their financial statements any contingent liabilities and commitments. A contingent liability is a potential liability because it depends on a future event arising out of a past transaction. Contingent liabilities often involve the following: lawsuits, income tax disputes, discounted note receivables, guarantees of debt, failure to follow government regulations. For instance, a construction company that signed a contract with the state to build a bridge may be sued by the state for using poor materials. The past transaction is the contract for building the bridge. The future event is the outcome of the lawsuit, which is not yet known.
In other words, if the future outcome is not known, it's not certain. And if it's not certain, the outcome, then it's a contingency or a contingent liability. If the company wins the lawsuit, they don't have to pay. If the company loses the lawsuit, they'll have to pay. So it's contingent, but the outcome is not known yet. Okay.
Okay. The FASB has established two conditions for determining when a contingency should be entered in the accounting records. The liability must be probable. The liability can be reasonably estimated. Estimated liability is like those for income taxes, warranties, and vacation pay that we described earlier meet those conditions. They are therefore accrued in the accounting records. In a survey of large companies, lawsuits involving many different issues and environmental concerns, including toxic waste cleanup, were among the most common types of contingencies reported. In a note to its 2011 financial statements, Microsoft described its contingent liabilities as lawsuits involving infringement of European competition laws, antitrust and overcharge actions, and patent and intellectual property claims, among others. Microsoft's management stated, we also are subject to a variety of other claims and suits. While we intend to vigorously defend these matters, there exists the possibility of adverse outcomes that we estimated could reach approximately 800 million in aggregated beyond recorded amounts.
Yeah, in
Where-
aggregate, does anybody know what in aggregate means?
No clue.
Yeah, in aggregate, whenever you hear that expression, it means in total.
In
Okay?
total, okay.
They're saying that total estimated contingent liabilities, they don't know what it is going to be. Maybe nothing, and maybe all, and maybe something in the middle. But they're saying the contingency is probably going to be about 800 million or so in total. That's what we mean by in aggregate. Okay.
Okay. Where unfavorable final outcomes were to occur, there exists the possibility of a material adverse impact on our financial statements for the period in which the effects become reasonably estimatable.
Yes.
A commitment is a legal obligation that does not meet the technical requirements for recognition as a liability, and so it is not recorded. Common examples are purchase agreements, construction, or acquisition of long-term assets and leases. For example, Microsoft also reported in its notes to its financial statements that it had construction commitments of 263 million and purchase commitments of 5.6 billion. Knowledge of these amounts is very important for planning cash flows in the coming years.
Thank you, Andrika. Thank you very much. And so now we add two things to our other list of stuff about determinable and estimated and so on. And these two things are what we refer to as these two new concepts, contingent liabilities and
commitments.
commitments. If the commitments cannot be determined or is not determinable, we do not put them into the financial statements at all in terms of the body of the financials, but we do show them in our disclosure in the notes to the financial statements. Because if you have those kind of commitments that have not yet materialized, even though there are no dollar values involved yet, you have to tell your shareholders and other readers that they exist. Some companies leave them off the notes because they don't want anybody to know, especially shareholders. They omit it in order to hide it. And if you're a senior management person and you say, as the CFO, that to the CEO, Mr. CEO, you shouldn't hide it, you should include it. And the CEO says, I don't wish to include it, I'm the CEO, you're the CFO. Need I say more? And the CFO should say, yes, I have more to say. In my professional opinion, and as a professional accountant who have professional and ethical responsibilities, we have to include it. And then the CEO will say, well, if you don't do what I say, I'll fire you. And you say, fine, you can fire me, but my ethical responsibility to this company and to my profession remains the same. Imagine how much better things would go if we had people with that kind of nerve. Of course, that's not in the written word, but in practice, it happens all the time. So contingent commitments are just that, they're commitments, but nothing has happened yet. It's like being engaged. Being engaged is a commitment, but are you going to get married for sure?
Nope. May not.
No. You're not sure. So if somebody says, let's get engaged, you say, yay, I'm getting married. Maybe. But at the time they put the engagement ring on, it's a commitment to marry. However, it's a contingency, isn't it? Because it will not become real until you walk up the aisle and say, I do. Because some people never get to the aisle. They don't show up. So the commitment fails to materialize. Some people walk right out to the thing when it says, do you take? And they panic and they run. So I changed my mind and stuff like that. So again, it can take, in some instances, right up to the last moment in business or personal life, where commitment could become material or not. Okay? In accounting, if it's just a commitment, we do not record it because there's no dollar value. We put a note to the financial statement that these commitments are there. They have not yet materialized into dollar amounts. For contingencies, we do not put them in our financial statement because there's no dollar value unless there are two conditions that can be estimated. One, the liability is probable, and then we have to figure out what's probable. And two, the liability can be reasonably estimated. Those two things have to exist so we can come up at least with an estimate. For example, is income tax and real property tax probable? Damn right it is. Can it be reasonably estimated? Absolutely. So those contingencies you can put in your records. In fact, we don't even put them under contingencies. We just put them under estimated liabilities because they are fairly certain. The only two that gives accounting people grief sometimes are contingencies in terms of how to record them or not, and commitments. And we're given clear instructions here on how to manage them. That's why it's important to know the rules and stay away from guesstimating. I think that somebody told me that. I think I dreamt that. We have to stay away from that stuff and try to get to the information that we actually need. All right. Before we move on to Cheryl next, I'm going to raise a question as an exercise for us. Indicate whether each of the following is A, contingent liability, or B, a commitment. Let's see how well that went down in the last 10 minutes. All right, number one, a tax dispute with the IRS. Contingent or commitment?
A contingent.
Contingent. Can anybody say why? That is correct. It is a contingent, and usually the reason why is because nobody knows what the hell is going to come out of an IRS dispute. Not really. Sometimes even the IRS don't know until they come up with their answer. So it's contingent on what the outcome is with the IRS. Do we have an IRS in the Bahamas now?
Yes, that's the VAT department.
Yes, Inland Revenue, not just VAT.
Inland,
Remember, VAT is not the only tax in the Bahamas.
no, yeah, inland
Okay.
revenue.
Yeah, but I get your point because VAT is the one we're stressing about at the moment.
That's the major one.
Well, that's one of them. Don't forget, real property tax is a tax.
What people pay or may not pay.
Yeah, especially rich people. They always want regular people to pay up their tax.
Why should I pay? Why should I pay real property tax?
And why should you pay it fast and pay it off?
Why should you pay it too quick?
You have a $20,000 balance. Why you want to go in with your $20,000 and pay it for what? The guy who owns who pay over $1 million should pay.
And they ain't even paying that.
No, they're not. The government of the Bahamas is owed $500 million in taxes, and they sure as hell don't represent poor working class people.
No, it don't.
I'm not asking. I'm telling you, for sure. Cheryl, these youngsters not even aware of all that craziness yet. They have a lot of stuff to learn, don't they?
Yeah.
And because they're the ones who are going to have to carry the burden in the future. We are going to be off somewhere. I don't know.
Well, I'll be walking my streets of gold in my mansion in heaven.
Absolutely. My thing is, after 45 I don't know. I don't give my age. I'm already too old already. I can't believe I've gotten to this point. The other day, I didn't even have children. I was 20 something. Man, worse than that, drove past the old St. John's on Market Street. I was a teenager, man. Some crap like that. And then suddenly I was just 20 something, dating, like, oh, my wife and I, she was my girlfriend. Then we just standing around. And I didn't have any children. Oh, nah. And then I'm like, what the hell? Where did the time go? And you're saying that, yeah, for the youngsters who think they have all the time in the world, I'm young, I'm sexy, and I'm young. Yes, you are. The time goes quickly, though. So do not procrastinate. Those of you who are the youngsters in this group, a word to the wise, sufficient. All right, number 2, a long-term lease agreement, contingent or commitment. A long-term lease agreement, contingent or
A
commitment.
lease agreement is a commitment.
It is.
Commitment?
It is a commitment. Should that commitment be put in the balance sheet?
No.
No, it's only a commitment. It hasn't been translated to action yet. Everybody get that? So it should be reported where? Not in the balance sheet, but where? In the notes to the financial statements. Okay? Number 3, an agreement to purchase goods in the future. Contingent or commitment?
Commitment?
Commitment, absolutely. Nothing has happened yet. It's only an agreement, and it's in the future. The fact that it's an agreement means it's likely to happen. The fact that it's in the future means that it hasn't happened yet. That's a commitment. It's like getting engaged. The fact that you have a ring on your finger is likely to happen, but because the wedding has not been set and Tom Jones and Mary has not yet shown themselves to the church, it's a commitment. Okay, and finally, a potential lawsuit over a defective product. Contingent or commitment?
That's a contingent.
It is. Does anybody disagree? Perfect. It's a contingent. Whenever there are lawsuits, we don't know what lawyers will do, what they will say, how long it will run, what decisions judges will make, what final decisions will come down from the courts. Nobody knows until we know. So therefore, the outcome is contingent on all of those factors, and we just wait. We do not report contingencies in the balance sheet, those kinds. We report them in the notes to the financial statements. Okay, Cheryl, you're going to take us for a few moments before we end. Do you see a topic called valuation approaches to fair value accounting?
Yes.
Okay, right there. Can you just start right there for us?
Recall that fair value is the price for which an asset or liability could be sold or exit the company, as opposed to the price for which the company could buy the asset or liability. As pointed out previously, the concept of fair market value applies to some financial assets, such as cash equivalent and investments, and to some liabilities, such as notes payable. Fair value is also applicable to determining whether tangible assets, such as inventories and long-term assets, have sustained a permanent decline in value below their cost. The FASB identifies 3 approaches to measurement of fair value. Market approach. External market transactions are ideal for valuing investments and liabilities for which there is an active market and quoted prices are available. For the specific assets or liability. However, an active market or quoted price is not always available For example, there may not be a market for special purpose equipment. In these cases, it may be possible to observe quoted prices for comparable types of equipment. Income or cash flow approach. The income approach, as defined by the FASB, converts future cash flows to a single present value. This approach is used when the market approach cannot be used because there are no identical or comparable quoted prices available. It is based on management's best determination of the future cash amounts generated by an asset or payments that will be made for a liability. It is based on internally generated information, which should be reasonable for the circumstances. For instance, management may estimate the cash flows or cost saving expected to be generated by special purpose of equipment. Cost approach. The cost approach is based on the amount that currently would be required to replace an asset with the same or a comparable asset. For example, inventory is usually valued at lower of cost or market, where market is the replacement cost for plant assets like special purpose equipment. The replacement cost of a new asset must be adjusted to take into account the asset's age, condition, depreciation, and
Okay, and obsolescence, yes.
obsolescence.
Crazy word.
Don't die.
Does anybody know what obsolescence is?
Outdated.
Yeah, outdated. On TV, they have a way of saying that when people have been married for a long time, that one or the other, the spouses, tend sometimes to become obsolete. What do you think they mean by that on TV? Obsolete. Is that a compliment?
No. If something is obsolete, it's useless.
Yeah, it's useless. It's out of date. There's nothing. There are no parts to replay. Nothing. It's just out of date. You can't use it for anything anymore. And so, for example, I just use the real world thing so you could remember. Even in accounting, we have obsolete issues with equipment that are no longer, the equipment changes, the technology changes, and you can no longer use the equipment you're currently using. Even if you want to, your competition has gotten you new equipment, they force you to get rid of your obsolete equipment and buy the newer version, that kind of stuff. Okay, so these things occur in accounting as well, and we have to be able to account for them when they happen. So fair value accounting has to do with the three approaches to cost. One is the market approach, which is if you want to determine the value of something, fair value, you go to the market and see what the market price is. What is the market accepting for that item? Doesn't matter what it is. Doesn't matter what you think it should be. Under fair market, it's whatever the market says they'll pay for it. If you don't agree, fine, keep your stuff and leave it. But if you want to sell it under the market approach, you have to sell it at market. If it's less than what you want it to be, too bad. If that's what the market is doing, you either sell it at market or keep it. Or you can keep it and think, well, maybe my equipment will sell higher when I go back to the market in 6 months. Maybe it might. Then you hold and you wait. Go back to the market, it's even lower than the first market. You find, wait a minute, this thing isn't going up. I need to sell this while there is actually a market for it. Okay, so that's market approach. We say it's fair because the market will determine, there's nothing personal involved. The people out there are saying this is all we'll pay, and that's what the market will offer. Then we have the income approach, which is based on future incomes coming in. So some operations, they say, okay, how much money can we generate from this over 5 years? We convert that amount of money over 5 years in income to the present value, and we say, okay, that's great. We recorded at this amount, and we'll treat the present value of those future cash flows coming in as the fair market accounting position. And then, of course, the cost approach is simply the replacement cost. If you have an asset that cost you $1 million 5 years ago, and you have to replace it, if the replacement cost is $2 million, that's what you have to use. If the replacement cost for some reason is 500,000, it's gone down, hallelujah. But whatever the replacement cost is, that is how you record it, and that's how you treat it in your fair market accounting policies. Okay, so those are the three principles that govern what we call fair market, fair value accounting in the accounting profession. And oftentimes we have to look at one or all three of them to see which approach our firm will use to actually record transactions. And so since fair market is based on the income approach, which the company can actually control, because remember the other two approaches the company cannot control. Company cannot control market prices. The company cannot control replacement costs. The only one of the three that the company control is its estimate based on income. And so that income is based on future cash returns on that asset that you purchase. And in order to calculate the present value of the future cash flows to determine how to record that transaction is to use what we call the time value of money. Anybody ever heard about that? The time value of money?
Yep, last semester.
Indeed. The time value of money is a very effective method for companies to use in terms of determining investments and how to record and what amounts to record the purchase of assets at. It is also a great way for persons who are looking to invest money to see how much money they can invest today to get a future amount in the future. So time value calculations are very useful, not only in accounting, but even in our own personal lives. The first thing you need to know about time value of money is the difference between simple interest and compound interest. Anybody in this group that does not know the difference? Great. Are they the same? Is simple interest and compound interest the same?
No,
What's the difference?
simple interest is based on the principal amount,
Yeah, you earn interest on a single amount.
right?
Doesn't
Single
change.
amount.
It doesn't change. Yes? And
And
compound,
the compound interest is based on the cumulative principal amount that's calculated monthly.
plus any interest that is accrued.
Plus, yeah,
Okay?
interest plus the principal
Yeah.
accumulated monthly.
So if you put in a CD in the bank for $1,000 and they pay you 10%, you at the end of the year you should get what? $1,100, correct? Correct, anyone?
Yes,
Okay. If you compound it, you leave the $1,100 and then you leave that for a year. So instead of paying interest on 1,000 again, you pay interest now on 1,100. That's how compounding works. And if you keep compounding it that way, you will earn much more money than if you just put $1,000 every year, single amounts. Does everybody get that? Or if you put 1,000 and get 1,100, and then at the end of the year, you say, "Thank you, Jesus, money." You take off the interest. So you'll never be compounding anything if you keep taking off the interest and leaving the same principal. But if you want more money, you leave the interest and have it compounded. Does everybody get that? That's something to think about in your personal lives in case you didn't really get that. Okay. So if your friend keeps taking off their interest at the end of every year and you leave it on, at the end of 5 years, you can have more money in your account than them. Because you are compounding your interest. They are only what? Getting interest every year on the same principle. Because every year they go in and take off the $100 or whatever the interest is and go to Miami again. Because we love to go to Miami or somewhere. All right. I hope everybody knows the formula for simple interest by now. If you don't know, it's right there in your text. PRT over 100. It's the same thing from 1957, whenever it came out, the year 2. If you're not sure how to calculate simple interest, please do a little practice session. Don't be trying to figure it out next week, Saturday. That will not be good. Okay? If you're certain already on how to do it, PRT over 100, great, we can move on. And so you can see in your example, in your text, how it's done. We calculate the interest and then we add it to principal, and so principal plus interest is the total. What is the total calculation that you have in your text. The simple interest. It's not in your text? Anyone? What's the total interest in your text? Simple interest that was calculated.
The total interest
Yes, so the total interest.
on the 15,000 calculated at 8% interest. The total interest would be $295.89.
Indeed. Notice that's the total interest over how many days?
That's over 90 days.
Correct. Be careful, not a year. Sometimes when we're doing simple interest, we assume it's 1 year. It doesn't have to be 1 year. It can be 30 days, 60 days, any number of days under 1 year. So be careful. Okay. But over 90 days or 3 months is 295. So the principal interest combined will be 15 plus the interest. So simple interest is very easy to calculate, as you can see. Compound interest, on the other hand, if you look at your example, the example in your text is the $10,000 example. Anyone?
Yes, 10,000.
Yeah. So you'll see now how compound interest works. In the first year, you put 10,000, you earn $600 on it. At the end of the year, you have 10,006. You don't take anything off to go anywhere. In year 2, you have 10,006. You pay interest on it. Now, instead of getting $600, you get $636. So now you're up to 11,236. And then you leave the 11,236 in, and so your interest is accrued even more. So at the end of the day, after 3 years, you're up to 11,910, which is a significant amount of money when you compound it. Does everybody see that? If you had kept taking off your $600 interest, you'll only be getting what? $600 each time. But if you leave it on, you get extra money. And that compounding amount becomes more and more significant as you put more and more money in the bank. But for regular working people, when we finally get $10,000 from somewhere and we could put it in the bank and not have to pay something, God forbid,
Mr. Wilkins,
yes.
what institution over here offers compound interest?
All of them, except that they don't promote it. Here's what I mean. We can create compound interest on our own as individuals by simply not taking off any interest off the account. You follow what I mean?
Okay.
Whenever you make a deposit,
Interest rate don't mean nothing, at least 1% and
Yeah.
0.5%.
nowadays compounding mean nothing. Even if you take it off, you have nothing, and if you leave it on, you have nothing.
That's the problem right there.
That's the current problem.
If you don't move your funds, you still get nothing.
No. So we're hoping after the pandemic, Dorian effects, the world issues and stuff like that, in 5 years, maybe they'll start paying us 2 or 3% again. God forbid. However, for those of you who don't know, credit unions pay better rates than banks. So if you want to earn a better return on your investment, a CD, for example, you might want to search out a credit union and see what kind of rates they're offering. I do believe they are better than banks at the moment. Have been for a little while. You can do a little more substantive compounding in that environment. Okay, so that's something you can check out if you're looking to actually make any money on your deposit and your compounding. Okay, sure. But the other banks, they are paying less than 1% in most cases. Some are paying 1% and looking at you as if you better be happy or get out. Some strange expression like that. Others, 1 or 2 might even be paying 2% somewhere. Maybe Commonwealth Bank might be paying 2% maybe. But Royal and CIBC, stuff like that, man, 0.00 something, less than 1%. If you don't like it, carry your money and put it on your mattress, I imagine, because you're not earning anything at the moment on it. So basically, all they're doing is carrying out what? Custody duties by keeping it, quote unquote, safe. And we're hoping they don't close their doors and run off with it. Hard earned 10,000, we took 1 million years to save. All right. So how do we calculate present values now that we understand what to do? Well, we have two ways to do it. We have the manual way to do it if you look in your text, and we have the tables. Of course, most of us should know by now that the table rates are easier, faster. The manual calculations are old time, last resort. If you have no choice, you can do it the manual way. For example, if you look at the $10,000 example again, we say to calculate present value, we take the $10,000 and we divide it by the interest rate, which is 1.05, and that will give us the present value, 9523.81. So the present value of 10,000 today is 9532.81. If you put 9532.81 in the bank today, in 1 year, if they're paying you 5%, you will end up with $10,000. That's how that works. Okay, using manually. If you're doing it manually, you divide the amount you're putting in the bank you want to earn by 1.05 or whatever the rate is. If the rate is 1%, it'll be 1.01. Okay. And then you can also show individually calculations, the present sum of a single amount. And you can see manually how that is calculated. For example, in this example, you have $8,000 from year 3 all the way to year 1, or from year 1 all the way to year 3. So we take the year 1, well, let's start at year 3, work our way back. The end of the year, we have $8,000 divided by the rate. As we saw earlier, we get a present value of X. Then we take that present value in the second year and we divide it by 1.05, and we have a present value of X. And then the same thing in year 1. And so now we see that the present value of $8,000 calculated year over year, we can actually see the individual present value amounts. And that's doing it manually. If you want to see those present values amounts for the calculation that you're doing. Notice at the end of the day, in this example, we're saying that the individual must invest a total of $6,910.70 today in order to have $8,000 in 3 years, provided that the bank or the financial institution is paying a rate of 5%. If the rate is not 5%, all numbers will vary. That's pretty straightforward. But the important thing is present values tell us how much we have to deposit today in order to have a desired amount in the future. And if you want to be able to do that, this is how we do it. Of course, this is the manual way to do it. There is a faster way. You guys should have a table in your book, 2 tables at least, table 1 and table 2, or in this chapter. Do you see it? Do you see any tables in your chapter? No tables in your chapter? Any tables in your chapter?
It's to the back of the book, trying to find the page.
Oh, it's at the back of the book. What a
Yes,
shame.
sir.
This thing I'm looking at is right in the chapter. You can just refer to it. But yeah, you should have a table in the back of your book that says present value of $1. And you should have a table that says present value of an annuity of $1. Those are the 2 we're going to be looking at. Anybody found that those 2 tables yet?
780 and 781.
780 and 781. All right. If you're going to be using tables in your test next week, tables will be provided, or you'll be allowed to look only at those 2 tables from your textbook. Okay, one or the other next week. All right. So instead of doing it manually, we can just use our tables. So using our table, we have a factor of 0.864 times 8,000 gives us the same 6912 that we did in all that calculation earlier, 1 year at a time. Okay. So if you don't have a choice, You divide and do it manually, but you will have a choice, so you can use your tables. And in the real world, you can use your tables. The question is, where did 0.864 come from? Anybody knows? Well, if you look in your tables, you'll see that we have a period going down to the left-hand side. Do you see that? Number of years or periods. Do you see that? And then at the top, we have the interest rates.
Interest rate is 5.
Interest rate is 5. How many periods for this example?
3.
3. So when they intersect, what rate do we get? Go down the 5 until you get to 3. And what?
I got 2.723.
I hope not.
What we supposed to be looking at? What?
Present value of $1 table.
Present value of $1 received.
What page is that on again? Is it 790?
$780.
Can somebody say where the tables are again? I think somebody said 790 and 791.
Yes, wrong. It's 780 and 781.
780 and 781. Okay. So the present value of $1 should be on 780 because that usually comes first.
Okay, and third period.
3 periods, which is 3 years, at 5%. When they intersect, what rate do you get? Anybody?
Is this the right table? This says present value of $1 received each period for a given number of time periods. That's the right.
Is that the table you're looking at?
Yes.
Okay. So if you go.
But the one that's saying for 3 periods at 5%, the amount I'm looking at here is 2.723.
That's because you're looking at an annuity table. That's not the one we want. Look at
Oh,
the next table.
okay. Okay, good.
I'm so happy you say that. Students of
The
lost.
the figure work looks right now.
Students,
0.864.
yeah, students have lost
What's the
points
difference between
because
these
they were
two
using the wrong
tables?
table. And then when they say, I used the table, how come I got this wrong? They said, you used the
Well,
wrong
why
table.
these table have the same heading?
I hope they're not the same.
It has the same heading. It says present value
Mm-mm.
of $1 to be received at the end. Well, let me see.
What
At
does
the
the other one
end.
say?
Okay, $1 to be received at the end of a given number of time period.
And what is the other heading?
And
say?
the other one said $1 receipt. That's the present value of $1 received each period for a given number of time period.
So they're not exactly the same.
No, not exactly, just it's very close to.
Yeah, the one that have rates that's less than 1 point something, 0 point something, that's the present value table. Those that have rates primarily with a full number in front of it, except for the first year, they are annuity tables. Okay.
Okay.
All right. So
Present value will be less than. Okay.
yes. Because present values are designed to give you a lesser amount, annuity tables are designed to give you more.
Great amount.
Okay. So if we apply the 0.864 to the $6,000, we can see right away how we can actually get the present value without having to go through all of the individual steps. Okay. Now, in the case of present value, if you're using the rate instead of doing all those calculations, you can just use the rate for each year. So the rate for year 3 is 0.864. Year 2 is what?
Year 2 would be 0.907
Year 1.
and then 0.952.
So you do it for each year using the rate, and then you add them up. And so the total present value becomes? If you add them up, you should get 16,338. That's your present value. Is that what you guys have in your text? 6,000 times the rate each year?
So we practically almost have to do the same thing then.
That's one method. Yes. Okay. Now, I see your point, but you're going to see something slightly different in a minute. Okay? If we want to calculate what the present value of a future amount is, we can either do it individually like we just did, 6,000 times the rate times the rate times the rate 3 times, or we can go down to the second present value table, and since it's the same amount each year, 6,000, we say that that is an annuity amount and it doesn't change. So since it's 6,000 for each of the 3 years, instead of using the present value factor table, we can use the second table, which is the annuity table. So we go to if we go to our annuity table, the 3 periods at 5%, what do we get?
On the annuity table, that's where we come up with that figure 2.723.
Yes, and we multiply it by the 6,000 annuity payment. What do we get?
16,338.
Which is the same amount as we did when we did them individually at the top, remember?
Okay.
So the important point to remember here is this. If you're using different numbers in each year, you will have to calculate the present value using the rate individually. If you are using the same amount each year, like 6,000, 6,000, 6,000, that's called an annuity. An annuity is an amount that you pay in of the same amount every year. Whenever you're paying in the same amount every year or receiving the same amount every year, then we can use the annuity table to calculate the present value. In other words, $6,000 for 3 years is equal to how much, anyone?
16,338.
I was
No?
hoping to say that. In the actual dollars, 6,000 for 3 years is equal to how much?
18,000.
Correct. But what is the present value of 18,000?
The 16,338.
Absolutely. Now you get my point?
Okay.
So if you want to save 18,000 in 3 years at 5%, you can use this rate, multiply by how much you plan to put into your account each year, which is 6,000, and you will see how much you need to deposit today, which is 16,338, in order to end up with what? 18,000 in 3 years. Does everybody see that? Speak now if you ever raise a question. Does everybody see that? Okay. If you don't see it completely right away, you will see it when it's time to do a little homework, something. Then you say, wait a minute. Okay, now I see it. Just now go back and look at it again. The point I'm making is, if you're calculating a present value amount of one single amount, you can either do it manually by dividing by the rate, or you can go to the present value table, get the factor, and multiply. So you get. So if you want to know how much to deposit, if you want to make 10,000 in 3 years, then you take the 10,000 and you multiply by the present value factor, and it'll tell you how much you need to deposit today. If you were planning to make a 6,000 deposit every year for 3 years, if you multiply it by the present value annuity factor, which is a 2 point something, it'll tell you how much you need to deposit today to end up with 18,000 in 3 years. So once you deposit the 16,338 or 335, you don't have to do anything for 3 years, and at the end of 3 years, assuming the interest rate remains the same, you will get the full $18,000. Okay? And this is what people who are investing and people who are looking to purchase assets for the company, they do. They look at present values to see how much money they need now in order to generate a certain amount of money in the future. Or if they're buying a piece of equipment, they say, okay, how much will this equipment generate in revenues every year over 5 years? And then they take that amount, let's say 3,000 a year. That's an annuity, multiply that by the annuity rate, and it tells you, okay, the present value of that equipment based on what we expected to generate in sales will be X. And that is the amount that are recorded in the financial records. Now, for non-accountants, that's a little bit much, but I just kind of threw that in there so that you can hear at least how it's used in practice. But now, what you need to be able to do is to be able to calculate the present value of an amount using either the manual method or the present value table, or the present value of an annuity amount using either the manual method or the annuity table. That's really the only thing you need to focus on at this point. Okay? When you start doing your review and when you get your homework, that's what it will be testing. All right. Okay. All right. And I think I'll stop there. I think I bombarded you guys enough for today. When we meet on Thursday, I'll probably just take a moment to discuss 1 or 2 accounting applications, not to confuse the issue, just to expose you to how accountants actually use present values in terms of acquiring assets, but that's not a big deal. If you are doing any homework on this section and you get stuck, you know what to do. Don't stay stuck. Send me an email. Let's get it sorted out. And certainly, if by Thursday's class you're still stuck and you want to raise some issues again, feel free to do that. Also, if you have any other areas that we've covered so far this semester that you want to raise a question or issue on, that you just want to hear some more clarification on, Thursday would be the day to write them down if you have any and raise them. You might not only be helping yourself, but also your colleagues. Okay? All right. Jerry, are you there? Okay, just checking. We know you're still honeymooning. You are not reliable at the moment.
So I was caught up the past 2 classes, yes.
Okay, no problem. The good thing about it is you can actually do your class from home, so you could stay in bed in your pajamas and all that. Yeah, let the wife spoil you, tell her come and sit in your class, listen to the nonsense you're listening to, stuff like that. All right, way to go. Okay, if there are no immediate questions, then let me give you the homework so that you can be off and running. Those of you who still have homework from the last session, you can please send them in. If you still have homework outstanding from the last session, and this, of course, is due for Thursday. If you finish before Thursday, you can send it. You don't have to wait until Thursday. And of course, Thursday will be a little discussion on blah, 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 one or two other points in chapter 11 and any other issues that you may have at the time. And then you'll be off to finish your review, your studies, and so on to be ready for Saturday morning. Okay. You should have been studying and preparing a long time ago. Please don't wait until the last minute. If you're a procrastinator, please get right into it this weekend without fail and every day until examination day. Remember, it's better to suffer now, and then after exam, you can take a break. Like Stephen Gardner and Shanae, run your guts out, and then you can fall down afterwards and relax. How's that? All right, homework. Are we ready? Okay. Number one, page 441. Number one, page 441. E2A. E is an egg, 2 apple. Number two, page 445. P3, requirements 1 and 2. Page 445, P3, requirements 1 and 2. Number three, page 446, P5, requirement 1. Page 446, P5, requirement 1. And finally, page 447, page 447, P7, requirement 1. P7, requirement 1. Most of these questions are not long drawn out questions. Maybe one might take you a little down the distance. The other ones are a little shorter, just to test your knowledge of the concepts that we talked about. So don't panic. Just go right into it and put it behind you. Remember, the sooner you finish your homework, the sooner you can get back to reviewing all your chapter materials, looking at any areas that are on the weaker side for you, any concepts. You can make notes of any questions that you're not completely clear on from the beginning of the semester. Raise them when we get together on Thursday, so you can go into your midterm examination feeling fairly confident. All right, any questions otherwise before we break? All right, fantastic. You guys, good luck with your homework. Get them in as soon as you can. Plan to study every day, set a plan so you can stick with it. I would suggest that one of the best ways to do your preparation for your examination, you've already read some stuff on your own. We read stuff in class. We talk about these things. So maybe a great way to prepare substantively is to go back and redo your homework and any other homework related questions that are similar. Practice them a couple of times and keep working them for the entire week, along with any other reading or review you think you need to do at this stage. I think if you do those practice questions over and over, homework questions plus any other practice questions in each of the chapters, the better you will be. Remember, just like Kobe and Jordan, the more you shoot, the better you will be at dealing with what you have to do. The more you practice, the easier questions will look to you come next Saturday. If you don't practice much, things are going to look funny somewhere along the way. And then we're going to have to find someone to blame, including God. So don't do that. Okay? Practice those questions. When you feel tired, stop and snooze and then go back to practicing them again. When you get tired, stop and snooze and go back to practicing them again until you're tired of them. When you're tired of them, you're probably somewhat ready. And that's how things work best. All right, so give it a shot. Stay safe. I'll see you guys on Thursday.
Good day.
Take care, Natasha.